Kia ora everyone, and thanks for coming back to our next edition of Econ Talks. Gareth, we've seen that the interest rates continues to be as high as ever. The Reserve Bank recently announcing in its May monetary policy statement a little bit of a different track, or at least having to address the elephant in the room around potential higher inflation, and starting to give some different clues around what might be next when it comes to interest rates. Before that MPS, we had sort of some of those longer dated interest rates, 3 to 5 year retail rates pushing a touch higher, but also those shorter term rates, particularly 1 year fixed mortgage rates, coming down a touch. What is the outlook coming through for interest rates over the next year or two?
Yeah, I think one of the intriguing things about the Reserve Bank's monetary policy statement was that interest rate track they published, which suggested, firstly, that from the second half of next year, the OCR would start increasing, and that has been brought forward, I think, by various forecasters over the last 6 months as the New Zealand economy has performed well, and attention has turned to potential inflationary pressures and when the Reserve Bank would start tightening. Not too worried about that, the particular timing on that, but then the biggest question was, well, where do interest rates go? How quickly do they rise after that? And Reserve Bank had the OCR pushing up to about 1.75% by mid-2024. Now, it's still not a particularly high rate, but it was faster, or it is faster than our current thinking on how quickly interest rates will need to rise, and it seemed a little bit inconsistent with the fact that they still had inflation, which was a little bit on the low side over the medium term. But thinking about those sort of interest rate issues, it is going to start placing a bit of upward pressure, I think, over the next 6 months on some of those shorter term mortgage rates. Probably pretty much at bottom for the 1 and 2 year rates now, and expect to see them heading in the same direction as the longer term rates over the next year or so.
So what does that mean for house prices then, and the general outlook? I mean, we've seen, of course, house price inflation at the moment still roaring in most senses across all parts of the country. And over the last year, we know a lot of people have got into the housing market. They're leveraged up to their eyeballs in debt. I mean, is this going to spell economic and financial doom?
Look, I think what I understand, talking to people about the interest rates that the banks are using when they're assessing people's ability to service a mortgage going forward, while we've obviously seen mortgage rates at record low levels of 2.2%, that kind of level, they've still been plugging in interest rates of up to 6% in terms of assessing can these people afford to service the mortgage when the worm turns, when those debt servicing costs push up. And so, look, do the maths on it. We're talking maybe a 1.5 percentage point increase over a 3-year period. That'd take your fixed mortgage rates possibly to the high threes. It's still nowhere near that 5 or 6% threshold that the banks have been working with. So don't get me wrong, it will start to squeeze some of that discretionary spending or discretionary money out of household budgets. But by and large, my expectation would be that people should still be able to cope, even with the track that the Reserve Bank has laid down.
I guess, though, with interest rates starting to head back up, coupled with higher loan-to-value ratio restrictions and this housing package that the government has announced with a particular focus, let's be fair, on demand-side activity, all of this, both in terms of our forecast, the Treasury's forecast, and the Reserve Bank's forecast, now expecting house price inflation to flatten out to barely anything within about 12 months' time. What's the thinking around that? Is that realistic to see house price growth flatten quite so quickly?
I think when you look across the range of other forecasts, apart from the ones you've mentioned there, most forecasters are still expecting price momentum to roll on for another 6 months, probably to the end of this year, and then those sort of monthly and quarterly increases to fall away and price growth to slow through 2022. I probably don't want to get too caught up in the exact timing of it, because I feel a little bit nervous about just how quickly that market momentum may disappear. We've got a lot of anecdotes. There's much fewer investors in the market looking to purchase property than there was previously, but it'll take a few months for us to really be able to see that in the data. But certainly, I think there is enough there in what the government has done, particularly when you consider the interest rate track that we've talked about. You consider the fact that net migration and population growth have slowed substantially, and that's really come through in the numbers recently as well. well. You take those factors into account, we're building at, well, almost 43,000 consents a year now, so well ahead of underlying demand. All of that suggests to me that the momentum should come out of the housing market, and I am comfortable that house price growth, if not by mid-22, then by the end of 2022, will have slowed substantially and be not too far above zero.
And I guess that's the thing with all of these different factors moving in that similar sort of position. There is an expectation that things do soften back in terms of that house price growth quite significantly. Interesting though that normally when we see that sort of reaction, or what we're expecting to see with house price inflation, you also generally see construction activity that might slow down quite a bit as well. We're not thinking at the moment that that's going to be quite as pronounced, and part of that presumably is because, look, we've still got this undersupply across the country, but related to that, there's also this big policy shift now where there's a wedge driven between buying an existing home and actually building something new. Those incentives on new builds likely to prop up actual construction activity better than where house prices are likely to trend, at least in the next sort of 3 to 5 years. Is that a fair sort of reflection of where things might be heading?
Yeah, I mean, I'm not expecting consent numbers to hold above 40,000 for any extended period of time, but we do have a massive pipeline of work that the construction industry is still trying to push its way through. Capacity constraints, supply constraints, limiting how quickly we can do that building work. And you're right, in terms of, particularly for investors, the incentives, if they are interested in putting money in property, still very much swung now towards new builds. And so that, all other things being equal, should actually keep that residential build rate relatively elevated and, not as affected by the slowdown in house price inflation as we'd normally expect to see when the market turns.
Well, look, I mean, we're going to have to keep an eye on these interest rates as we go forward. I mean, they are quite an important thing that everyone seems to keep an interest in, and also something that people are definitely going to have to adjust their expectations around where they put future investments, what they're thinking about when it comes to making big decisions around their money. So we will continue to assess them and see not only where the Reserve Bank moves, but just as importantly, where the retail banks move as well, because they've also been told that they've got to up their capital holding requirements from next year. So quite a lot in the mix in this space. Like I said, we'll keep watching and look to update people when we come and back and do one of these next sessions on another version of Econ Talks.